Estate planning along with your retirement account. I'm Gary Anderson, financial advisor, Anderson Advisors.
And I'm Kevin Tharp, elder law and estate planning attorney.
And Kevin, we've been talking about your estate plan, coordinating your estate plan with your overall retirement account, but making sure you have the correct estate plan and making sure you're getting that estate plan and that direction from someone qualified to do that. And I said earlier, I'm a financial advisor. That's what I do. Don't ask me to do an estate plan for you. I'm not going to do that. I'm also not going to give you advice with the estate plan you have right now. That's not my job. I think sometimes people default to, the financial advisor will give me that information for free. Well, you're probably going to get what you paid for there. And it's going to be very disappointing potentially down the line if you do that. And I think sometimes, too, people don't understand how the estate plan works with taxes. Does it make any difference to have an estate plan like you're talking about now with taxes?
Gary, there's two types of taxes. I tell my clients this all the time in estate planning. There's two types of taxes that we work with in estate planning. The first one is called the inheritance or death tax. And for many of us, that's not going to be an issue, because the current limits right now are $11.5 million per person. So if you're married, it's $23 million. And most of us don't fall in that category. I told a client the other day, he goes, we're not in that category. And I said, welcome to the club. Welcome to the club. It's a big club. There's a lot of us.
Very large club.
Very large club. So your kids don't have to worry about paying any death or inheritance taxes, federal or state. The other tax that we often deal with is the income tax, and particularly in estate planning. And here's what I can tell you about the general income tax rule when it comes to estate planning. There is no income tax on the receipt of an inheritance, with one exception to that rule. No income tax on the receipt of an inheritance, except for if I inherit or you inherit a retirement account. Because as we talked about in the previous segment, we talked about during your segment, is there is a tax tail that always goes with that dog called a retirement account. I don't care what type of dog it is, 401k, 403b, IRA, I don't care what type it is, there is a tax that goes along with it. There's a saying that I tell my clients all the time, IRAs equal IRS when something happens. You know that if you have money in a 401k, 403b, or an IRA and you withdraw it, you're going to pay tax. If you withdraw it too early, before you're 59 and a half, you're going to pay a penalty on top of the tax. You know that once you can let it sit there for a long time, and now once you reach age 72, you have to start taking some of that money out during your lifetime. And you withdraw money out for whatever reason, you're going to pay tax on it. When you pass away and you leave it to somebody, there will be taxes. If I leave my 401k to my spouse or IRA, she may not pay tax on it when she gets it, but eventually she's going to have to start taking money out of it because I was. And she will pay tax then. When we leave it to our children, they will pay income taxes. So the tax is always consistent, okay? And this tax is always consistent regardless of who your beneficiary is. The difference is, depending on who your beneficiary is, they could pay more taxes or less taxes, but there's no taxes. That's one common theme with all of these different accounts, is there are taxes with your retirement account. So if you convert your IRA to a Roth, guess what you're doing as a part of that Roth, that conversion? You're paying tax. So again, that tax is always there. So when I recommend a trust as a beneficiary, it has nothing to do with tax planning. Yet consistently, I hear back from my clients' other advisors, typically a financial advisor, but sometimes even a CPA. Oh, you don't want to make a trust the beneficiary, you're going to pay more in taxes. Who your beneficiary is will not change the income taxes. There are three choices that our beneficiaries have when it comes to taxes when I die and I pass it along to my spouse or my daughter. Those three choices are first, Missy has a choice of rolling mine over into hers. That is a tax-free transaction, but at some point down the road, particularly when she reaches 72, which could be 50 or 60 years from now, she's going to pay income taxes, right? So it doesn't get rid of the tax. It's just the transaction of rolling it over is tax-free. All right. The other choice is she could take it all at one time. If I leave her $300,000 in an IRA account, she can take it all at one time. Now, she's going to pay a big tax bill, probably 40% of that in taxes, because $300,000 is going to put her in a higher income tax bracket. Or the third choice is she can take it out over a period of time. And the maximum period of time she can take it out is 10 years. Well, my daughter has only two choices. Take it all at one time or take it out over 10 years. That's it. But there will be taxes. So why make a trust the beneficiary? So it doesn't matter who the beneficiary is. Taxes will not change. So why is it best to make a trust the beneficiary instead of my wife first and daughter second? Asset protection. My 401k, my 403b, my IRA, and the same applies to you, is the most protected type of asset, Gary, you can own, that I can own, that our listeners can own. Out of all the assets we can own, it is the most protected type of asset. Unless you get a divorce, it's protected.
You're listening to Truth in Planning. I'm Gary Anderson, financial advisor.
And I'm Kevin Tharp, elder law and estate planning attorney.
Kevin, that's a really good point. The taxation of a retirement account, of any type of retirement account, IRAs, 401ks, things like that. That is different than it would be with a Roth. Like you said, Roths aren't taxable after you've made maybe a conversion into a Roth. After that, nothing you make is taxable there. I think a lot of times people think they are avoiding taxes when they set up particular types of retirement plans, estate plans like you do, and they get confused when all of a sudden they still get a tax bill. But like you said, the IRS, they're still going to get their taxes.
Yeah, there's taxes involved if you withdraw it during lifetime, regardless of whether the trust is a beneficiary or your spouse and kids are the beneficiary or grandkids or whoever. The taxes are always there. So who the beneficiary is not necessarily going to eliminate the tax. It's just going to say, do I pay more tax or less tax? And when you make a trust the beneficiary, there are IRS rules that have been around for over 30 years that say that a trust as a beneficiary is treated just like an individual. There's no separate tax for the trust and then the individuals. The IRS looks through a trust if the trust meets some basic requirements that all of our trusts meet. The IRS calls them a look-through trust or a disregarded trust or a pass-through trust. So it doesn't change the taxes. They look through the trust and they look to the beneficiaries of the trust. So asset protection is the reason we recommend making your trust the beneficiary. Because if my trust is the beneficiary of my 401k, I pass away, that money goes, and then my wife is the beneficiary. They're going to look through that and say, oh, well, Missy is the beneficiary. She can do a rollover. She can do a lump sum. She can do whatever, but it adds an umbrella of protection if Missy survives me, but she's incapacitated.
So protection is the goal.
Protection is the
goal with the estate planning that you do.
Absolutely. That's the main reason, the only reason we recommend making a trust a beneficiary is asset protection of whatever's left of that 401k IRA when you die.
Kevin, this is something I think people would love to be able to have a conversation with you about. And I know you do this and you enjoy doing that because you're educating people on something that a lot of times you just have been confused on over the years. The average person out there, you don't do this every day. I don't work on cars. I'm not a mechanic. If you ask me to be a mechanic, your car might not ever run again, so I stay away from that. I let somebody handle that who's really good at it. And I think this is what people need to do is start off with being able to have a conversation with you. Talk about it. And I know you do this as a complimentary consultation.
This is one of the most common questions I ask is why make a trust the beneficiary? And Gary, this is a good place to start. Call us at 866-253-6994, or if you don't remember the number, remember the name, KevinTharp.com.
You've been listening to Truth in Planning on North Georgia's News Talk AM 550 and FM 102.9 WDUN.